Perfect. Well, I think we're having everybody join us shortly and connecting to audio. So good afternoon, everybody. Reintroducing myself, my name is Duncan Hensley, and I am the Research Challenge host for this year's Southern Classic Challenge. We're lucky enough today to be joined by two of the members of our subject company, Southern Company. The first being Scott Gamble. He is the Vice President of Investor Relations and Treasurer for the Southern Company. He's responsible for overseeing communications and relationships with the investor community and responsible for all treasury functions at the Southern Company. He's worked at the Southern Company for the duration of his career following graduation from Auburn University. And we're also joined by Investor Relations Manager Ashley Black. She joined the Southern Company after beginning her career with PricewaterhouseCoopers and attended the University of Alabama. So some strong ties to our sister society in Alabama. So without further ado, we'll hand it off over to Scott and Ashley, and there will be time for questions at the end. So Scott, Ashley, over to you guys.
Yeah, thanks, Duncan, and thanks all of you for joining us. Excited to be selected for the host company for this year's Research Challenge. Look forward to sharing a lot about our company today and seeing the byproduct of each of your challenges. So with that, I'll turn it over to Ashley. I know we've only got a half hour, so we'll jump right in.
Yep, I'll echo what Scott said. We're excited to see the results of your project in February of next year. And we sent over the presentation in advance to really kind of give you a high-level overview of the company and then give you some additional kind of modeling details that you can use as you're building out your model on capital and financing plans and all that good stuff. With the short time frame we have today, we're just really going to focus on some of that high-level stuff. And then I know you guys will be made aware of how to send, your follow-up question to Scott and myself afterwards, if there's anything else we can provide insights on. So with that, going to our next slide, just a reminder, we'll make some forward-looking statements today. Scott and I can't predict the future, and so it's just our best projection of kind of what the future will hold. And then, with all companies, generally, there's as reported earnings and then there's adjusted earnings to really kind of signify those things that are part of the ongoing business. We're just going to talk about adjusted earnings today. So starting at a super high level of the company, we really have capabilities in all the states in the United States. We own 7 regulated electric and natural gas companies. And so the electric footprint that we have, you guys are probably all very familiar with that in Mississippi, Alabama, and Georgia. The gas companies that we own are in Illinois, Texas, Virginia, and Tennessee. And so that's really kind of where our regulated businesses are owned. And so when we say regulated, that really means that there is kind of a state public service commission body that is really put in charge of regulating the business and really understanding what the capital investment profile is for that business, and then ultimately the rates that we are allowed to charge customers. Overall, we have 9 million customers in those regulated jurisdictions. And then just to give you a sense of Southern Company's size, we have about 27,000 employees across those various jurisdictions that we talked about. So we spend a great deal of time as a company on this slide. There's a few really kind of important pieces of information that I want to highlight for you here. If you look in the far right-hand corner, you see this circle. And at the center of the circle is the customer. And we really view this as our guiding light in how we make decisions. We believe that, as a company, we're always balancing a lot of interests from various stakeholders, whether that's our regulators or our customers. And so we kind of believe that to really make the best of the customer, I think there might be someone who might need to go on mute. So we kind of believe that if we ultimately make decisions with the customer at the center of everything that we do, it really will hold a balance for all the other places that we are trying to juggle and meet expectations. And so when we talk about having the customer at the center, that means that we're focused on providing clean, safe, affordable, and reliable energy to those customers. And so those are our aims. And so we kind of measure that by seeing the reliability that we provide those customers and the satisfaction that they have with the service that we provide them. And so putting the customer first and at the center really allows us to continue to have a constructive relationship with our regulators in those states. And by having that constructive relationship, they generally allow us to continue to invest capital for the benefit of customers. And so that's really what we mean by the circle of life and putting the customer at the center. And then, deploying that capital, we ensure that those things in the bottom of that circle, high reliability, high customer satisfaction, and high, best in class kind of pricing as it relates to national average pricing is really what we're focused on. And so that really is how we think about running our business. Another thing that's important on this slide that we, often will talk about really as we're talking about our long-term value proposition is the things that we think make a premium utility. And the 5 things that we have captured there, what we're really laser focused on, we think that the first thing that is very important for a premium utility to have is credibility. And that's credibility with our customers and regulators and really just doing what you say you're going to do. That's a number 1 focus of ours. The next is a competitive growth rate. From an EPS perspective, that doesn't mean that we're aiming to have the highest growth rate, but we're looking for the best risk-adjusted return. And so that's really how we think about EPS communications to the street. The next thing that we think signifies a premium utility is having strong credit quality. To be a premium equity, we also believe you have to be a premium credit. And so for us, we really think about managing our credit in such a way that we really have kind of cushion to our thresholds, our credit thresholds. We don't really want to operate with a thin margin there. And so we're very focused on that. We've talked a little bit about constructive regulatory relationships, but we have worked for decades to build those. And so we really think that an important thing there is some of that credibility that we talked about, communicating with our regulators on what our plans are and really having a 2-way dialogue. That's very important to us. And then lastly, as we really think about the transition that really every company in the US is focused on, but certainly utilities, is having a fleet transition kind of outlook on how we reduce carbon emissions. And some ways in which you can do that is having meaningful regulated renewable investments. And so that to us is another kind of important quality for a premium utility. And then before we leave this slide, I'd be remiss to not really highlight a huge part of our total shareholder return is the dividends that we pay to our shareholders. And so we have paid a dividend for 76 consecutive years, and we've increased it for 22. And so that is a part of our value proposition that we're extremely proud of. So we'll switch gears just a little bit and talk about some of the specifics of what our EPS guidance is. And so for the current year in 2023, we recently had our earnings call a few weeks ago. And so we actually narrowed our guidance range from 355 to 365 to the midpoint there of 360. You can see really the parts of our business that make that up. I would say that this will probably be helpful as you're thinking about building out your models. One thing that's really rewarded in our industry is having a large part of your EPS being provided for from the state regulated businesses. And so you see that for Southern Company, ours is around 90% of it, so of our EPS. At the bottom of the slide, you see that we also kind of are giving a nod to the long-term EPS that we aim to have. And so spend just a little bit of time there talking about the nuance. So if you think about our long-term EPS guidance, it's 5 to 7%, and that is off of a base of 2024 earnings. And so you see the base there is 395 to 410. As you're thinking about your models, 2023, almost think of it as a unique year. And the reason why it's unique, you can't really take your 23 earnings as you're putting in your model and then go to 2024. You'll see that that's something higher than 5 to 7%. So if you went from 360 to what we have there for 2024, it'll be higher than 5 to 7. So I would just kind of urge you to separate those two out. And without getting into too many details, the reason why we really have looked to 2024 to talk about the basis on which to grow our long-term earnings is because we are finishing up the nuclear construction that probably many of you have heard about called Vogtle. And so we're building the first new nuclear reactors in the United States in the last 30 years. And so we are just on the, the edge of being, having those behind us. And so as those come into earnings and are part of our overall financial profile, that's why we've kind of looked to 2024 as we talk about long-term EPS. Okay, so we'll switch gears just a little bit again to talk about how investors actually value Southern Company. And so, anytime anyone is coming up with a target price for a company, there's really kind of two main components. Your first is going to be your EPS estimate for that company. And so what we have captured on the slide here is $4.31, which is the current Wall Street consensus for Southern Company for 2025 EPS. And so, as you're building out your models, I'm sure you will arrive at an EPS estimate for 2025, and you would have something kind of similar to this. The other component is the price to earnings multiple. And really it just stands for the dollar kind of that an investor is willing to invest today for a dollar of future earnings in the future. And so generally, if your PE multiple is higher than an average, you really are assigned what's called a premium PE multiple. If it, for whatever reason, is below the average utility or below the average in whatever sector you're looking in, then you have a discount multiple. And so the PE multiple weighs very heavily on really kind of what the target price may be from, the various Wall Street analysts that cover your stock, and determining what the target price or the share price would be for a particular company. And so those are two kind of really important components to think about as you're thinking about kind of the value for a company as it relates to a stock price. So spend just a second here talking about what Southern Company's historic PE has been. So you see on the left-hand side of the screen that Southern Company for quite a while traded at a premium to our peer group, or really to the average utility. And so for about a couple decades, we traded at about a 12 to 15% premium to the rest of the industry. And so you see that even in certain periods, it was even higher than that. But on average, we were at a premium PE. You see in the middle of the screen there that that sort of started to change around the 2013 timeframe. And really kind of the key thing that happened in that period is we started some large construction projects. Probably the one that is, top of mind for investors is the nuclear project that we talked about, Plant Vogtle. And so as that construction really got underway, you see that the premium that we had for a long period of time reverted to a discount. And put simply, if you're an investor, you want to go to sleep at night believing that you're going to wake up to the same stock the next day. One thing that would make an investor a little bit nervous about that is a company that has a large construction project, because despite your best estimates, things sometimes go wrong. And so some investors really kind of put a discount on a company's earnings when they have a huge construction project, and certainly a first of a kind construction project. And Plant Vogtle really fit that bill. As I talked about, there really hasn't been any nuclear construction in the last 30 years. And so there's a high degree of execution risk in investors' minds dating back to 2013 when we started that. However, you see in the right-hand side of the screen in 2023, we made significant progress at Plant Vogtle. We brought the first unit online in July. And so, as there have been some major milestones this year, you've seen our stock revert from this long-standing discount we've had for the last decade, reverting back more to a premium. And so I would tell you that that is what investors are grappling with somewhat, trying to determine at what, level of premium Southern will trade at in the future. And will it kind of revert back to that long-standing PE premium that we had for quite some time? So the utility industry is a little bit unique and a little bit weird. Some of you guys may have already kind of cracked the code on this, but to the extent you haven't, kind of just wanted to paint a really kind of base level understanding about how a utility makes money, because I think that would be very important as you're thinking about building out your models. At a super high level, a regulated entity is regulated by the state utility commissions in that given state, and it allows them to earn an authorized level of return or ROE on the equity invested in the business. In that blue call out box on the left, you will see that the formula is pretty straightforward. It sounds complicated, but you really just kind of need 4 major components. And the first of which is your rate base. You can think of rate base as just a fancy word for the capital investment that a utility can deploy in its regulated jurisdictions for the benefit of customers. And so that's why we'll talk a decent amount about the capital opportunities that we have on subsequent slides. So you take that, and that's really the basis for how you calculate net income, taking that rate base or capital investment. The next part of that is the actual equity that you're deploying as a business to fund that capital. And so that you'll see in the bottom right, we kind of provided you with an average equity ratio in our regulated jurisdictions. I would use that. And then the last component to arrive at net income is the average ROE, the average return on equity that you're allowed in those jurisdictions. And we also provided you some averages there just to make it easy as you're thinking about how we earn on our investments in our regulated jurisdictions. So those 3 components get you the net income. As you know, the language of EPS is really net income over the number of shares you have outstanding. And so that's how you can really think about the EPS that Southern Company, for example, is how we really think about modeling what our EPS is in the future. And so those are the real components that you need to get there. So on this slide, we'll go down just one more level to really talk about how the revenue is really established for a utility. On the right, we're kind of providing an example of how you might think about if you decided to own a lemonade stand. So a really simple example to maybe kind of demonstrate something that sounds pretty complex, but really these are all the moving pieces that you need to understand how a utility works. So should you decide you want to, let's say you're a kid and you want to have a lemonade stand, to do that, you got to have some assets to really set up that lemonade stand. And in this example, your hard assets are your table, your signs, and you have a very fancy pitcher that you're serving that lemonade from that's $100. So overall, the assets to start your lemonade business are the $1,000 in this example. And so as you think about those assets, you're a kid, you have no way to fund it. And so you've got a couple different things that you're going to utilize to get you that $1,000. And the first of which is you're going to fund 45% of it with a bank loan. You find a bank that believes in your business model, and so they give you a loan for $450. Since you're a kid and you've got no money, you ask your parents for the other $550. And so ultimately, you take the combination of those two, and that's how you're going to fund that $1,000 of assets. And so your equity percentage there in that example is 55%. And so let's just say on that 55%, you're allowed to earn a 10% return on that investment. And so you kind of take all those things in combination. You take your $1,000 of lemonade assets and you multiply it times the 55% that you got from your parents, and you know that you're allowed to earn 10% on that. That's how you arrive at the $55 of net income you see in the bottom of the slide. And so utility rate making is almost a little backwards. You start with the net income that you know that you can earn, and then you have these set expenses that you know it just takes to run a business. You first have to have some lemonade powder. You're not going to squeeze those lemons by yourself. You need some cups. You need to hire a friend to help you run the stand. And then you've just got some, non-exciting expenses that just any business would have, like property taxes, interest, income taxes, and then depreciation on the assets that you bought. And so those are all the expenses that it takes to run the business. And so working your way backwards to get up to the revenue that's required, you need $380 of overall revenue to get to the net income that you need. And so as you're really thinking about how a utility makes money, I just, suggest that you come back to this slide often, because it's really kind of a simplistic way to think about how it works for a regulated utility to make investments and translate that into net income. So, as we talked about, rate base and the capital opportunity that we have in front of us is really important for a utility and really is the basis on which you're earning. And so you will find for utilities, the investment community in Wall Street is very focused on what your capital investment opportunity is. This slide was in our Q4 deck earlier this year in February, and this is our 5-year capital plan. You see that Southern Company is investing $43 billion of capital for the benefit of our customers. And 97% of that is actually concentrated in those state-regulated utilities that we talked about for our electric business and our gas business. And really the makeup of the $43 billion is 75% or so is in our state-regulated electric jurisdictions. About half of that is related to making the grid stronger and more reliable. And so that's kind of transmission and distribution investment. And that's really kind of the largest part of that is comprised of those types of investments. You see that our state-regulated gas business is about 20 to 25% or so of that overall investment. And really there, the opportunity is replacing old and aging pipes. And so about 65% of the gas capital that we talk about is really to serve that sort of need. And so this slide is just a nice kind of reference to come back to as you think about where Southern Company is really investing in the business and the kinds of generation, transmission, and distribution that we're focused on, and then 5-year plan to support our business. So the left-hand side of this slide is really just kind of a repeat of what we just talked about on the previous slide, but we also pointed to in February the fact that we have about $3 billion or so of additional capital that we have allocated to our Southern Power entity. So we've talked a lot about regulated businesses that we own. Southern Power is really a competitive generation business that we have that also can deploy capital. And the way I would think about it is largely that opportunity set is in areas outside of where we have the regulated businesses. And so, for example, we just announced 2 acquisitions of solar facilities, one in Texas and one in Wyoming. And so those are the sort of opportunities that we think of Southern Power potentially executing on, but we kind of lay it out as upside to our base capital plan. So you notice that that $3 billion was not part of the 43. And really what we're trying to communicate is we have some upside opportunities that we may execute on, but they're not really dependent on us earning our 5 to 7% EPS because we kind of view those as more of upside. And then in addition to that, these little bubbles that you see on the right-hand side are kind of capturing some things that are potential other opportunities that are upside opportunities that we really don't have in our base plan. And the first of which is probably an easy one that we talked about on the first slide is that we still believe we're going to have meaningful renewable investments. And so to the extent our regulated businesses find opportunities to deploy those would be upside to the $43 billion. As you guys know, as you probably looked at our business, we roll forward our capital plan and financing plan and EPS in our February call. And so to the extent there are other opportunities that we identify in February, they could roll into our base capital plan. And then we very much will probably still have an upside capital plan, very similar to what you see on the right-hand side of the screen. And then, lastly, this is the last kind of prepared slide I had for you guys, is just to really show that as you would expect, sometimes you're limited by your imagination. And so in general, our capital plans tend to grow as we get closer to the next year. And so in this example, when we roll forward capital in February of 24, there's probably a pretty good chance that the base capital plan grows as you get closer to that given year. The other thing that Southern Company does that in some ways sets us apart from other peers is that we don't include placeholder capital. And so what that means is our capital plan is really our base view of what we can execute on in the business. Some people perhaps kind of know what EPS they want and they back solve to the capital that it takes to get there. We don't think of it that way. We think of our capital plan as really what is required to serve our customers. And we build our capital plan, and the EPS that comes out of that is the result of our capital plans. And so because of that, as we get closer to any given year, we have more insights on what we're going to be able to do in that year. We get a lot more granular, and we have a lot more details on how we can do that. And so in general, the capital plan continues to grow as we get close to the next year, for example, or the year after that. So with that, I know that was a lot of information very quickly, in a little bit under 30 minutes, but that's all I have in terms of prepared remarks. There are, appendices where you've got capital and financing plans and all that good stuff, but would love to open it up to hear if there are any questions or anything that we can kind of respond to during this session.
Yeah, to Ashley's point, I mean, I think she walked you through how to model at a high level kind of 90% of our business that's regulated. And so we tried to put together a lot of robust information in the appendix that you can use to actually put into the model.
David, so
David,
you've got a hand raised.
Hi, Scott. Thank you so much for taking the time to do this today. I really appreciate your time. My question is, what are some industry-specific metrics, aside from the PE ratio, that equity research analysts often use to assess the company on both an operational and financial level?
Yeah, absolutely. So I'd say on a financial level, you know, as I actually talked about, our regulated businesses get decisions on how much we're allowed to earn on our investments from the different regulatory bodies from our states. And so a lot of people look at the amount of equity that we're allowed to earn on within the investments that we make, and then also the level of return on equity that we get. And generally what you find there is, you know, if you focus on your customers and keep customers happy, then you have a constructive regulatory relationship, which generally leads to higher ROEs. And so all things equal, if we're investing a dollar in utility infrastructure at 10.5%, we have a peer that's investing a dollar and earning 9%, then generally we're viewed as a more high quality utility. And then the other piece there too is, as we go in for rate proceedings, you know, how quickly are you able to earn a return on that investment? To the extent that you can only go in every 3 or 4 years, sometimes you're investing and not getting a real-time return on that. And so that leads to a phenomenon called regulatory lag, which leads to your actual earned return on equity being lower than what you're allowed. And so another thing to look at there would be not just what you're allowed to earn, but what you actually do earn on a year in and year out basis. And utility investors are generally pretty risk averse people, and they look for really kind of regular, predictable, sustainable earning streams over the long term. Another thing I would look at as well is credit quality. It really is a buffer to adversity. And so looking at, you know, credit ratings, again, with utility investors being somewhat risk averse, you know, they want companies with, you know, high credit quality. And we firmly believe that in order to be a high quality equity, you've got to be a strong credit. So we're laser focused on that as well. And generally the metric that's looked at most by investors and financial analysts is FFO to debt, which is funds from operations, or basically the amount of cash flow that you get in on a yearly basis compared to how much debt you have to finance your business.
Thank you.
Sure.
Yeah, Troy, go ahead. You got your hand raised.
Hey guys, thanks again for taking the time to do this and answer these questions. Just real quick, I know this is industry standard for the most part, but can you guys provide any clarity on your outlook for equity issuance, and then the primary purposes behind that moving forward?
Yeah, I'd be happy to talk about that. So our current plan that we kind of have talked about on the previous slides that we released in February, it has no planned equity issuances. And so right now I would say that is zero. You know, I think a good indication of maybe the quality of credit metrics that Scott talked about, that FFO to debt, is really kind of what has differentiated some in our industry. There's some currently who have been adverse to equity over the last few years. And so you've actually seen their FFO to debt deteriorate somewhat. And so there are probably some peers leading into next year who may need to issue more equity to kind of fix their balance sheet and credit metrics. You know, based on our current capital plan, we do not have any equity needs. we'll roll forward our capital plan on the February earnings call, our Q4 call. And so the way we talked about it on our last earnings call is, to the extent that our capital plan kind of grows significantly over current expectations, we may turn on a little bit of equity. And we will do that primarily through what is really kind of our dividend reinvestment plan. We can turn that on at the beginning of the year, and we have what's probably one of the largest ones in the industry, where we can get about $350 to $400 million a year of equity from that. And so as we sit here today, that's probably the only likely path in terms of equity needs, since we have a strong balance sheet and kind of credit metrics. Any other questions that I can help with?
You must have stumped him, Ashley. Oh, David, you got another question?
Yeah. Real quick, I know that the Vogtle plants have had a significant amount of delays relative to the initial plan. So I was kind of wondering what factors contribute to projects being completed on time and under budget? And then are there any major capital investments upcoming similar to like the Vogtle plants? Thank you.
Great question. So, as I talked about, when Unit 4 goes into service next year, we will be the only utility that's constructed a nuclear plant in the last 30 years. It was not really supposed to be that way. As we started that construction phase, there were others who were aiming to do that. Constructing new nuclear is really hard, is really kind of the best way that I can describe it. The Nuclear Regulatory Commission is a fair but tough regulator. And so the standards on constructing nuclear in the US are really tough. So it's not anything that anyone would take lightly. But I will say, there were others who were starting nuclear construction at the same time we were. None of them are currently doing it, is sort of what I would say. All told, when we ultimately get the unit constructed next year, it will be about a 14-year construction process, to give you a sense of how long it's taken us. And really, there are probably three main factors that really besides it being really hard to do it, that led to it lasting longer than we expected. The first of which was the Fukushima disaster. I don't know if anybody remembers that back in 2011, but it was a major disaster that kind of really affected the nuclear industry and really kind of caused some of the safety protocols that are required for nuclear, especially new nuclear, like we were doing, to change somewhat. The second of which is, we had a fixed price contract to develop nuclear. Unfortunately, the entity that really kind of gave us that fixed price contract went bankrupt. And so that certainly was not in the cards for us. Basically, since they had given us a fixed price contract, and as costs continue to rise, they really couldn't meet that obligation. So ultimately they filed for bankruptcy. That certainly was not within the expectations of what we had hoped would happen when we started that project. Thankfully we had the wherewithal to really come in and step into that process and kind of lead it as the lead, entity on the job. And so we were able to overcome that, but it certainly was a setback. And then the last of which was COVID in 2020. If you think about it, the rest of the world shut down. Our nuclear site did not shut down. We kind of responded and worked through that, doing all sorts of things that actually cost us, both time and mainly additional cost to keep that unit up and running. So, certainly a pandemic like that was not really expected as we started nuclear construction. But, it's been a long and tough road, but we're super proud to have those units coming online. They will serve customers for the next 60 to 80 years. And as we're thinking about kind of the carbon intensity of resources that utilities use, nuclear runs 24/7 and it's carbon free. So it's an amazing resource for customers, but we're really very, very glad that we're getting close to having it complete.
Yep. Troy, you had your hand raised, and then James will come to you next.
Awesome. Thanks again, guys. So I understand you guys are not necessarily in the business of trying to predict long-term rates. But given that 43 billion of capital being invested over the next 5 years to meet the various goals, paired with the roughly $7 billion of debt maturing by July 2026, just looking for a little bit of color on how you expect to finance a majority of this, and as well as really just a breakdown between financing and then how much is of it's going to be organic and financed through cash flow.
Yeah, good question. You know, I would say that as an industry, that Wall Street analysts and investors are really excited about some of the growth prospects for our industry. There's been, especially in the Southeast, there's been a lot of economic development and a lot of tailwinds related to economic growth, which is awesome. But to your point, it's going to cost a lot more to fund the business. You know, as we sit here today, when we actually talked about our 2024 guidance earlier this year, we actually brought down the top of that range to something. It used to be 430 at the top, but we brought it down to 410 at the top. And really, I would say that the primary driver of that was the interest rate headwinds that we have. You know, I think as an industry, if you probably asked us a year ago, I think people thought, oh man, we've got higher interest rates for 23 and 24, but surely it won't be this high for so long. I think that everyone has come around to the realization that rates are going to be higher for longer. And so I think that the entities that, you know, within our industry that have looked for opportunities to de-risk their financing will be able to weather it, but it's absolutely a significant headwind. You know, as interest rates were low, some people maybe took advantage of that by having maybe shorter term paper. We sort of did the opposite where, you know, we actually had a slide in our last earnings call deck that you could go and look at, but our average tenor for the instruments we have outstanding is 16 years, average coupon about 4%. And so, you know, from that perspective, we have one of the best debt portfolios in the industry in terms of taking some of those de-risking steps. But as we look over the plan horizon, I mean, you know, we certainly, you know, believe that the rates will be higher for longer. And so because of that, you know, we've got to do some things to be creative to manage manage those as best we can. We did something this year, which was really a convertible debt instrument that allowed us to issue debt at about 150 basis points of savings to what we could have done versus a traditional debt instrument. So we're looking to do things like that. You know, another thing that can really kind of set you up for success in this environment too is not having too much floating rate debt risk. You know, Southern Company's portfolio overall, give or take on when you look, is about 10% of floating rate debt risk. And so said another way, you know, about 90% of that is locked in. But, you know, we'll look to do things that like that convert and other kind of, I guess, resourceful and interesting ways to fund that capital plan over time. Because, you know, as you said, we do have some maturities over the next little bit. And then, of course, as we talked about, you know, we do expect kind of some growth capital as we roll forward the next plan, which will require a mix of some debt. And then, as I mentioned, if it grows significantly, probably most likely we'll turn on our equity plans in the form of that DRIP plan to also supplement some of that growth.
Thank you, guys.
James, go ahead and ask your question.
Thank you for taking my question. What are your best resources for getting your forecasting data?
You know, internally, it's interesting. You know, Scott and I on the IR team, there's just two of us. And, you know, as we talked about, we're a big company. And so we really do rely very heavily on our internal teams. And so it comes from a few different places. In terms of our EPS and, you know, credit metric outlook and all that good stuff, it really comes from our financial planning teams internally. And actually, both Scott and I spent other parts of our careers on our financial planning team. And so we have a team in Atlanta that kind of consolidates all of our financial plans across all the companies that we own to develop what our 5-year capital plan is. And so that's built up from many different groups across the company. You know, as we talked about, our capital plan is a huge part of how we really, you know, set a baseline expectation for what our 5-year plan is. And so there are obviously, you know, capital planning teams that, you know, that's all they do is manage capital projects and develop those budgets. You know, another big component for utilities is understanding our sales growth as well. And so we have another team that's really focused on understanding what our current customers are and then maybe what also our future customers are. We talked about this a little bit on our last earnings call, but we've seen historic levels of economic development growth in our service territories. And so because of that, we're kind of constantly iterating and adding in our views related to that and the impacts on sales growth, which drives revenue growth, but then also kind of what else is necessitated from a capital standpoint to be able to serve that. Having more cells is fantastic, but without the proper generation and T&D to get the electricity there, we wouldn't be able to serve customers. And so it's an iterative process as we're finding out new information to make sure that our capital plan and our outlook are constantly staying in sync with that.
Thank you.
So I'm not seeing any more hands raised now. Do we have any more questions? And as a reminder, as Kathy mentioned in the chat, oh, there we go. Tristan, go ahead.
Yeah, can you guys talk a little bit about some of the characteristics of the competitive environment of Southern Company and what that looks like for typically a natural monopoly?
Yeah, that's a great question. While, from the outside, it seems like it is to your, the comment you made about it being a monopoly. Yes, we are a regulated utility and we're a vertically integrated utility. As you guys are looking at us compared to peers, you will find that the Southeast is a bit unique. I mean, there's a few other kind of markets that are similar to ours when they're vertically integrated. And what that means is that we do long range planning that allows us to invest generation, transmission, and distribution to serve customers. In some markets, like Texas is a good example. You might have heard of the ERCOT market. It's an organized market. And so in that market, you don't have a single vertically integrated utility. And so there are what we view as kind of some suboptimal decisions that are made there where perhaps energy is kind of given greater priority over capacity. And so what that means is that, there's more incentive for people to build kind of assets that really kind of are kind of more short-term focused. You wouldn't see any nuclear being constructed, for example, that's supposed to last 60 to 80 years because that market doesn't necessarily kind of reward capacity. And so that's just sort of some of the differences in how our market is set up. However, our commissions are kind of charged with making sure that we are serving customers in the most affordable way possible. And so while, it is a monopoly, so to speak, there's a tremendous amount of oversight in kind of every decision that we're making for the benefit of customers to make sure that the things that we're doing are really in the best interest of customers. In some ways that you can see that are in some of that reliability that we talked about, keeping the lights on. Some of those other markets that I mentioned, if you have a winter storm Elliott like we had in December around Christmas, they might have lost their power. We're happy to say that our utility, our service footprint did not. And so that's just sort of a nod to the way that we plan for the future and that we make sure we have the right generation there to serve customers. Another thing is customer satisfaction. If the customers are really kind of getting what they need from a product perspective and the commissions are making sure that we're planning in such a way for them to get that, that's another kind of marker that you can look at to compare Southern Company to other peers. And then, the last thing that I would say is price. Our prices are below the national average in terms of what we serve customers. And so that's something that's always top of mind for us. And certainly our regulators are focused on that as well to make sure that as we're investing, that it still remains affordable for customers to do that. Great question.
Xiao Meng, go ahead and ask your question.
Thank you. So may I know currently or in the near future, what are the Southern Company's largest investment risks?
I think from a capital standpoint, I wouldn't say that there's any risk the capital we've identified in a meaningful way would not come to fruition. However, like I said, it's always up to our regulators to approve our capital plans. We work with them to review it with them to make sure that, what we're doing in their view is the best capital to invest for customers. But What can be a focus in an inflationary environment like we're in is making sure that the rates we charge customers, that we're doing everything that we can to mitigate rate impacts to customers. And some of the ways that you can do that is, as you're deploying capital, like we're talking about, managing O&M expenses. And so you constantly got to be thinking about ways to drive efficiencies and ensure that, you're doing everything you can from an O&M perspective to make sure that customer rates are staying below that national average that I talked about. And that, we think of it as more than just we're really, really involved in the communities that we live in. If any of you guys, have known about Southern Company in your communities, we take really great pride in being involved and really being a partner in the communities that we're in. But we realize that electricity service is just kind of one component of what customers are paying for. They're getting new notices about their insurance going up. Anytime any of us go to the grocery store, you look at your receipt and you're like, I just bought 10 things. How is it possible that it's this expensive? And so we're thinking of it in that full context. While we're focused on electricity and the cost that customers are paying, we're thinking about really how much less ability they even have in this current inflationary environment to even pay that electricity bill. And so we're really, really focused on doing things in the most efficient way possible.
Thank you.
Thank you. Well, tons of great questions today. I totally appreciate the engagement. Duncan, did you see anything else?
I don't see any more hands raised now. As a reminder, and Kathy mentioned it in the chat, each team is allowed one round of follow-up questions. So both Ashley and Scott's emails are included in the chat. So if you'd like to go ahead and note those down, and you can send over a round of questions to them, there'll be like I said, one per team for that. I think another question that we'll also have is a recording of the presentations and slides, and that'll be made available to everybody as well. So you'll have a chance to kind of review what we've talked about today, and then as well as the slides that were presented. So if you don't have any more questions now, we'll go ahead and wrap it up. But once again, Ashley, thank you. Scott, I know had to drop for a different call, but we appreciate your time and your presentation today, and we look forward to seeing what all the teams put together for you all in February.
Yeah, we're super excited to see that as well, and appreciate all the engagement today. Tons of great questions, and we look forward to your follow-up questions. Hope everyone has a great afternoon, and happy Thanksgiving next week.
This is Kathy. So I just wanted to know if it's a question only. So just each team gets one question. Thank you so much.
Thank you, guys. Take care. Bye-bye.
Yep.
Thank you.